So I think I said something really bad about Fibonacci, and I think Fibonacci is a great risk tool because it gives you the expansion and extensions that start to be logarithmic multiples of the previous. But I really wouldn't want to take this and try to attach to the chart and say what'll happen. But I think as far as getting your brain around how much you would risk if you traded 4 orders with a master stop, if you just take Fibonacci right out of the box and put the 100 at the 100 round handle and the 0 100 pips below. Now imagine the market's plunging and it does one of these maneuvers where, and of course you're going to, after you determine this risk of, you're going to buy here, your first buy limit, and the stop is here for that. So when you write the script, or you're just going to hand place orders on all these orders just like this. You have to put this in here with the stop here. You put this guy in with a hard stop again. You could have a feathered out stop, and this guy is going to buy and his stop. So the risk keeps kind of coming down. So you can take all these numbers, add these together. So your total risk on buying a 4 micros or 4 minis. So on the micros, you're risking $2. This is probably like $10. Let's just say this is $15 because you hit the button twice, or $30, right? Now that's the thing. This order spread here might look great on the dailies, or might great on a 4-hour chart. You have to go into the game and look at the last known candle and determine what the market's current ATR is, and now you're going to gauge to that. Using Fibonacci as your I will buy and risk. On a mini, I'm risking $61 here to make way more on the upside because it's going to go into Fib expansion levels above here. And that's why this, when the market's plunging, getting in logarithmically, where you get in denser and denser at the bottom, but in a Fib compression. So you're using Fibonacci, you're picking the price based on current ratios that make sense for whatever's going on. Then you got that scaled out Fibonacci. You're scaling out like a natural plunge or a natural climax. You don't want to sell. You don't want to anger trade into, like the market's plunging. You're like, Jesus, you gotta be kidding. You just can't keep hitting the buy at the market button. If you throw out these banks ahead of time, or you place these orders on the daily, and imagine the fill, right? You have, say, a 4K here or $40,000 fill. Now, with the master stop, you've accepted, you know what? Get me out. I start buying as soon as we plunge 61 pips without going any lower than 61 pips because it's going to blow out the whole bank. And maybe you have another one of these set below. And as far as how you place these banks, right? Now the magic of MT4 is that this could last for 15 minutes or 12 hours max. Now there are 12-hour scripts out there, so if you got to get on an airplane and you're going to go get drunk, you put the 6 hours, the 8 hours, but at different price levels. Now imagine that. You could also, although this is all limit order entry here, this is a plunge, catch a falling knife in a Fibonacci compression strategy with a master stop and just accepting that total script. What is that worth? And you could write a button, press that. Now, what I wouldn't do is keep pressing that button and just stack up, because forget about it. The way these markets move, you may get just tripped on, say, 6, right? 2 fill on the other one. If you waited, or you have a button that does the same thing in a pocket, a 50 pip, 100 pip pocket. So if you're sitting here and you know that they're going to take this to new lows, and you put in your 100, you're going to start buying here at 60 pips deep, and you're going to you're going to get filled on that, right? You got filled on that, just that chaos of, even here, you started buying here into that wick, no fill that day. This day, total fill, right? Now, if you're buying in, say, on every 50, you have the script start. So the 61, your first and worst fill, these are the tighter stops, and these will make more money on the upside. So when you're getting in here, the exit's going to be up here. This guy's going to get out as the first scalp, right to here, the 100. So you're really saying, oh, I'm going to, the market comes down here. When it hits this order, say it crushes through all these guys and it doesn't get out of anything yet, right? And it hasn't stopped you out. You're really risking 23 pips, right? The Fibonacci, the 23.6. And it comes in, it just misses that, it nicks it. This is the perfect scenario for this script. Comes flying back. The moment it gets to here, it needs to take something off. If this is your exit. Then it comes back and it's like, oh boy, but it never gets near your master stop. This is the perfect scenario. But this is a compression entry. Or maybe you have a Fibonacci inversion off of the initial entrance here. This is the fulcrum here now, and you attach an inverted Fibonacci over here where it looks like this, attached to that, where your exits look like, some inversion of fib on the other side. You don't have to get out where the but this is a neutral master stop. It's easy to think about the math here. You just take this as your total risk, and your reward is going to be that this 618, which is your worst fill, which you took the most heat on, is going to get out at the 4236, 43.26. Now this is just a logical progression of 618 keeps rolling over. So had you placed that order bank here and you did not get stopped out, in a perfect world, you started buying this 50 pip wick, and since you got in at 63 pips down, maybe they didn't hit your stop, but maybe you had another order bank every 25. It doesn't take much. You're going to make a tremendous amount of money, 4 times your money, right? So if you zoom out, I'll have to go back to the now, if I compress the chart, say you're coming into this window and you keep dropping this script and you're like, oh my God, I keep picking these guys up, and there was the scalp, right? You got out. Your first fill was here. You never filled in this last ticket. So you're not in for the scalp. That one would have got out here at the 618. But if you can just picture in your mind, now you can't change the ratio here because you wrote a hard 61 pip worst stop case scenario, 61 pips here, risking 50, risking 38 pips. Now when you go look north to see, well, if you just let it ride, right? You let it ride. You got your scalp to the 618, so you've taken off the bottom order. I'm sorry, you got out the 100% on this bottom order, so you made 70 pips, right? The other guys are still riding. So you've actually taken something off the table. So if we come smashing back, you're not going to get so burned, because the master stop, you never want to change the break even. You just never, you never want to, you got to let these things play out, because you should have had that built into it on the front end. I don't think you want to fix it in the mix. Like, oh, maybe I should. You move stuff, you're never going to be able to be consistent with that one play that is a hard script. Presupposing you're not just hitting the market buttons and like a kid in a candy store, you got some discipline to say, I'm risking a tremendous amount. There's $61. That total script is $200 blowout, right? You blow that thing out, you lose $200, but you're going to make $800 or something, right? Or you make $600. Triple your money. So you just compress the chart, and then this is the daily New Zealand dollar. This is back in January, the end of the year, and just kind of like a silly, big, the end of the year swing trade, crazy, right? Go figure. And then you can press the chart and you see your this order here would have got out about up in here. So you're really up on this trade. And this is if you didn't touch the account. You're not a scalper. You're a swing trader with a 61 pips hard stop on a 4K or a 40K or a 400K, right? It wouldn't matter. Fill in the blank. And you can see in hindsight and foresight, of course, this is limit only entries. This is catch a falling knife. Actually, the bounce is bigger than the fall. Kind of setups that happen. And you can kind of see them at when the market's going into Extremeville. So if you would have done this on the Canadian dollar, you can see on the dollar yen, letting that whole script play out, but knowing you're coming into this, it's reached that point, and so this exit, you got out here in a perfect world, you got out here on this one, you got out here, on the 50 you got out here, and on the worst fill you got out here. Your total risk was this block, whatever that number is. Say this is $100, and this is going to be, I don't know, because you got to take the difference between this, which I don't know the math on that. It's not, if these were just good old numbers, but it's not. It's a Fibonacci expansion thing. But notice how the Fibonacci queues up to close. If you're going to use Fibonacci, if you really are, seriously, put it on closing prices. Don't do this wick stuff. That's when I'm going to have to call the Forex police. Look how this doji hits the 2618 on the daily better than, and look how this closing price is resistance. Never put your fibs on the wicks. I've said it once, I've said it a million times. This is a great risk tool. But look how it queues up. Everybody's thinking the same thing risk-wise based on that many pips. Now, if you scrunch this down and said, well, I only want to risk half of that, I'm going to put a 11 pip stop on my last order. Now you're living in this world, right? It's a whole different world. You're making tons of money. This is the scalper script, right? He's going to risk little itty-bitty amounts. I don't know what the spread goes on in this currency. But now in this case scenario, you might want to think more like buy stop guy and put buy stops stacked up on the top of this, and it just takes you in like a zipper. Never looked back, right? And not only do you have that, you have this zipper entry. Yeah, you're cashed out by here, but you're out on that wick. In other words, it blasts through that whole zone. And look how if you're going to enter here, you're still getting this hit on here, the doji. Yeah, but cue it off the doji, because that's where everybody's hesitant. That's the key, not the wick. You can't put your fib on the bottom. I guess you can. You can do anything, right? You can jump on a window. In the end, the fib's just keeping you from over trading. It's just a compression tool, right? So, yeah, I could say, oh, look from this to this, you know, swing out, swing low. It's going to hit on something. I guarantee if I just throw it up here, as soon as, if the market can go north enough, oh, yeah, look at, it's crazy. Look at it topped out right at the 4. That's crazy. Look at it. Look at it. Yeah, see, I don't know. I didn't rehearse that, right? You're going to get hits, right? But you buy or sell at that level. And what does it mean? If you want to make this money to here, oh my God, right? Are you up for all this up and down shit? I mean, come on. Look at, so take your fib and hang it on the doji if you have to. So doji to doji, right? Here's a doji. Right to the center of it. You know there's a triangle in there. Hey, look at, went up to the 2618. But it also went to this, right? But did you sell it to this 1618? Or did you get clobbered by that wick? So if you get lost in the fib queuing to price as opposed to queuing to what's in your bank account, you can't live that life. Like, you can sit there and tell me, oh, look at this. Yeah, right. You're going to sit there and endure this pullback of 300 pips when you could have got the hell out up here on just a simple retest of that wick, or you didn't sell on limits up there, just in bozo trading. So yeah, I know fib tools, it's great, but I'm thinking in terms of like, look at this expansion and risk. If you're going to risk, so if you're one of these guys that want to risk 100 pips, you want to risk more, so you want to risk 200 pips. 618's got to be 4 bars on this to be a now the 618 is going to risk 1, 2, 3, 150 pips. And on the buy limits, you could stand in front of this market without any fear. Your first order fill is here. You didn't even fill this bottom order. You didn't pick up on that. But look where your targets are. Totally hit. It goes beyond that. Amazing trade. Just by determining, and this compression down here, my God, when the market gets like this, you're 100%, you're measuring from 618 is your first buy limit entry to the 0. So you just know mentally that, okay, that's going to be, in other words, this 100 has to be at the 100-yard line, which is here, because it's a 50 pip grid. But you have to pick this ratio up front. So you take all your losses up front, 618, that's $66 or $60. And you're queuing that. These are amazing trades. Even to here, you're already out. Boom. If you were risking this window, you don't care about the fact that it went up to 1 million extensions. You have to be realistic. This is a daily chart. Like, you could re-enter on this doji if you're really that crazy about it, or you're selling up into this like a madman. And you've got this same tool, but you have the inversion right on the sell side. So you pick your risk ratios up here. Imagine you're placing this guy on the north side. You already know this high exists, right? There's a shaved candle or whatever. There's a complete about face up there. Drag that puppy, place the 618. Of course, you got to set this to 2 bars from the 0 to the 100 is here. And now 618 north of where you're at is your sells. So you place it, the 618 on the wick. And I guess you didn't get filled here. Here they just blew through your order. Here you put it in. 618 here. They blew through this order bank. So the problem here is you can't trade the when the market's starting going to 200 pip wicks, you're going to have to trade bigger. So if you're up for that, now here you would have said, oh, put your 618 at the last known wick. Okay, now it's almost, you can almost make money there. If you just put your 618 at timed out grids on the 50 handle, then it, you know, you have to be able to say this trade's too big in this pair. If you're trying to make that many pips, you're going to have to double your risk. So you take this, like the double mint twins, you take it up to here. So now it's going to be a 44 pip stop on that top. Still getting it to 618, which is a 120 pip stop. Worst stop, right? The bad stop here would be you just lost 120 pips on that. It's 120 pip wick. So now you have to say, well, you really want to trade this thing on the daily wicks? I don't see the point, right? You're not going to place, you can't afford to place big orders in here. So you have this thing so far out. You have to sell there. Then you have to have a tremendous amount of risk, right? These guys look like this now. The 618 has to come in. If you're going to start selling at a fake out of this, that's insane. You can't trade big on that. If you trade too big on this wick, so the perfect case scenario is what it went up there to get filled, and I don't know what that is. Like now it's too far away from my. I don't know math. That's like a 300 pip stop, right? You're so amplified in the top of this market, and for all the orders to fill, the first one to fill on sell limit was the 618, and with about 180 pip stop on that. Never gets near that, and it does fill the last order. But by here, you're underwater severely on this. The other option is to make this a very tiny order and make this one twice as big as that and make compression so that when you fill this order, you're buying a 5K with a tighter stop. So as soon as you go away from the profile of this simple master stop idea to zero and just count the pips in between the here, so I guess you're at 100, 200, 300 pips stop here, right? 300 pips sell stop. Your first fill is at the 618. And you, just by scooching this a little bit, you see you wouldn't fill that top. If you had to place this way too far high and you just filled that top order and you hang into this trade, where does it exit on the 4 going the other way? Well, it hasn't gone out yet. But here we are again back at the 2168. And this is why people will say, oh, look, see how it works? Well, hell, if I just threw it up there like an idiot, it works, right? Put it at the 0 up here. Oh, look, it's bouncing off of these. If you threw up on the screen, you'd have the same effect. So, but I'm just counting the pips on here, and I'm just who didn't want to sell this thing? Getting a 300 pip risk here, and you're already out of most of the position except for the last order down here. On the weekly, all of a sudden it looks like, wow, that kind of trading happens all the time on the. Like, imagine this same script. And this window up here is a lot tighter. You totally made that. This wick here, I don't even know if that's... Oh, that's the end of the month. Maybe real data on there. I don't even know. That's when the markets came unwrapped. Now, so risk-wise, and Fibonacci extension for the master stops at 0. Your last fill is at the 2, 3.6. In a perfect world, the market came slamming up into here, never stopped you out. You sold into it like crazy right on the bottom of this candle. You ride that puppy all the way back out. They don't quite fill that though. So, but look at all the wicks here at this. So maybe you don't put 4 orders in, but you could put 3 in. So you could trim out the last one, put in a wider stop, forget that last order, or maybe forget the top order. Start buying at the 50. So a less aggressive approach is if you take out the 50 entry, that means that the 618, which is your worst fill, which is supposed to get out the 423.6, that's gone. You just take off the, go into Fibonacci and take off the 618, leave the 50, and now you're set buying at the 50. So that may be a better way to go. If you trim out this thing, imagine this doesn't exist and your 618 doesn't exist. You're only going to start buying when it really goes nuts in, so you're only buying a 3 position. So it's a less greedy trade, and it's a higher probability trade, and I think 3 is probably it's a tighter compression. This 4.2 is a little bit, that's double this, so it's not even super greedy. But look at this entry here. If you're getting in when it's quiet here, see you're out here at the top. You don't have to, like, maybe it is going there. I don't know if that's real data there. I guess it did smacked up there. So, and on the stop entry side of this, if this was a stop script, which I would consider to be a trend script, not a plunge to the end of the earth script like this, where you keep buying and picking up with your stop here. And so if you're going to get it to 50, it's easier to do the math now. You would just forget that top order. And so let me just go and take it off. I guess I can't look at it. So just delete the 618 entry. Now you're going to buy 50 pips deep with a hard 50 pip stop. And Also, you're going to take off the outlandish greedy take profit. So if you just take those two out of your fib and keep it to 3 orders of the master stop and just practice the writing scripts or placing orders in this array here, because this is a lot more likely of a reversal schema. And even for the trend burst stop entry, if you're going to set this at a 10 pip, so if you put it to a 50 pip risk on your stop entries, they're going to look like this, where the 100 is sitting at the 50, so you're only risking 11 pips on your scalp. So you put, instead of the 100 being here at the 100, and well, that's good, I guess, with this currency. I can't even imagine, right? You have to be on, you have to go to the other time frame to even imagine trading this, right? It's got, you got to be living over here, because this is so many pips. That's the 4 hour. Here's the current daily. So here was your last entry. It was this doji here. So this is just a silly candlestick trade. They're a dime a dozen. A high probability setup anytime you see a small body. So you take your fib tool, which I guess I just destroyed on there. I guess you got to click and drag when you drop this puppy. So here is the fib taken down to just taking the outlandish entries there. So what would be the best? You're going to start buying at the 50. You have a 50 pip stop. So that's all you can afford. So you turn on the grid here to see, to make sure you set this at. So you're really looking to make, I guess, double your money. I'll just say that's never a bad thing. And you can also have the wider risk version of this. So if you go to the hundreds, the 50 pip stop looks like this to make whatever pips. Here is a entry. Say you buy at the breakout. This is the daily chart. So yeah, this is very low risk, right? You're getting in here. So if your stop is, if you're going to buy in limits, market closes and you put your first entry at 50 pips below the low of the day. And they, sure enough, they kick it back, you know, they kick it back in. And so you have a 50 pip stop and you have 3 orders in there. And maybe they didn't fill this last one because when you see when you slightly adjust that, it makes a world of difference. You got all 3 fills here with a somewhat tighter stop. But if you use the same 50 pip stop and keep everything consistent, put the 100 on the 100, and just change the size of the orders maybe. This way you can just constantly just know, okay, or you forget the 50 pip handle and just put the 100 pips, but if you have to figure, you got to get your brain around how much you're actually risking, and seeing that you may have to run them. If you got a day job or you're running 3 of these, 3 versions of these staggered, not only are you going to buy this one, but you're going to stagger 20 pips. If you do a stagger of 20 pips, you will not repeat. You don't want to repeat any of these numbers. So if you drop 3 of these, slightly offset, and maybe they're logarithmically offset, if you can imagine here, then no duplication, then really deep, then insane deep. In other words, it's going to look like, in the end, you would have that order bank, 3K, 30K, this order bank, in time, out in the future. And these things are also decaying as time goes on. This one is a capture net. So you have these, and you just literally have, or you have it hard-coded that you're going to drop this kind of end of the world script that gets out at the, so these could all be coexisting. You're willing to, and you know that each one of these is worth whatever. This is like the end of the world script, right? The market's going to come down and it's just going to fill. You just got a series here, right? You get it blown out. You keep pressing this button every 4 hours. Yet you have to really look at this on a 4-hour basis now. So if you're going to keep your stops at 50, now you got to go in the 4-hour world and say, okay, well, what am I willing to go here risk-wise? And meanwhile, these kids have been cashing out all in the rearview mirror. All these are great trades. Let's see if I can grab the same scripts. So these would be your scripts, basically what they look like. And you're just looking to capture these 50 pip wicks. So ultimately you're looking for setups like this. And so now every 4 hours you're dropping the same script. What's the chance this market dips 50 pips? Pretty damn good. So even here, you know you're uptrend, and you keep dropping the same order bank that you've already calibrated for its risk pip-wise. You're always trying to make 200 well, actually, it's going to be a little more than 200 and no, it'll be 260 pips, right? Because you bought it to 50, but I guess you got to do the difference between that 50. It's not really zero now. So I don't know about the math on that, but because I never really, to me, looks to me like triple your money. Buying at the 50 though, the capture zone here is pretty tight. Now to risk 100, just take it to here. That is double. But you cannot trade big on this currency if you don't like to see your account continually blown up. So on the 4 hour even, this doji, right after the completion of that doji, you could have put a limit in at the bottom of that and picked up 2 tickets. And those guys would have cashed out at the 2-6. So your exits would have, if you held through that 4 hour swing, this you never got this scalp fill. So the 50 and the 3-8 cash out. So you don't get the you do get this price here, because this would have gotten out at the 100. This guy would have taken the 80 pips off the table at the 100 now. So now that this guy's exit has been reduced to the scalp to the 100, so you're still making quite a bit there. I mean, you're making like 80 pips, 70, what is that? 76 pips without the spread. Because you got in down here, you're getting out at the 100. These 382 is going to get out at the 1618 and this 50. So you're only on the 50 in this. You don't ever get the 100. But it does go up there. After this fill down here, it does go up there. And amazingly, the 50, and this is the reason why people keep coming back to this Fibonacci. So the 50 hits a doji for the target if you scooch it around just right? So you can go, oh, look at that doji. So that's a big mind game. But in the end, it's about, there's a difference between these two scripts of at least a magnitude of double your money, double your fun. Or you could just take this down to, I'm going to buy a 23 pip stop looking to make my intensely greedy 261. You know, take out the 50, forget that, right? Now, you could also just cruise around and buy at the 38 all day, 38 stop. Hard stop, one order. But the 38 is going to get out at the 1618, right? That's the logical maximization. You just can't, depending on. Now, when the news comes out, and this is just a hairy pair. This is probably the most volatile currency pair on the planet. So think about this stuff here. If your broker's giving you a good spread, and every half hour you're dropping this Fibonacci risk compression entry limit 3K or 30K, and your first entry is at and I guess you have to really trade this on a 1 hour basis, apparently, with this script. I'm coming to the conclusion right away here. Because if you set 0 and you set this to actual pippage, that's 100 pips between 100 and 0. Your first buy limit is at the 50. So you're going to put your first buy limit, say, you get this insane doji, right? So this is just trading the grind on the 1 hour Euro New Zealand, which is, what a spicy pair. You know, I kept looking at that thinking 300 pip, I would never put a 300 pip stop on a daily trade. Like if you're trading this pair, you might want to really seriously think about the 1 hour chart. Because you're going to be, wow. Just scalping this thing is looking to make 100 pips. So if it's pips you're after, maybe you have to even make this a 75. But I'm going to say, let's go 50 pips stop here, which looks like that's what you got to run. If you pick every doji and every hammer you see on this thing, come on, put your 50 buy limit. You know this down candle exists, right? And you know there's probably a retest coming of at least 25 pips, right? That's basically a, well, from the 50, that's, what is that? So you're buying 50 is your new 0 entry. And you never got filled on that bottom order. But you know you're risking a hard 50 stop if the whole bank filled and this guy would have been the big winner. This top one would be the big winner. So the worst fill gets the biggest exit, which is amazingly, and this is why people keep on harping on this Fibonacci, is because just like when I was doing that Gann risking at a 45-degree angle, people love 45-degree angles, and or nature loves a 45-degree angle. People are actually nature. So even if you're just pulling the trigger on, say, here you got a doji, so it means that's a triangle. I better put a buy limit for retest of that. And luckily they did not plunge more than 50 pips, so you got to fill. And this order did not fill the whole order. So if you loaded 2 of these styled scripts here, so it would look like this on the same the script double loaded at different intervals without repeating any of the entries would look like, say, this. So I'll buy here. Maybe the 50 is at the market order, and the other one is all limits. But see, there's duplication here now, so you don't want that. It has to overlay so that there is a it's better to think of it like this. You have 2 trade plans here. Now you're risking 6, right? This one is, I'm going to change the color so I can say this would be my stop entries, and market orders would be blue, because stop entry is pretty much isn't it really just you don't want to kid yourself, right? You're definitely taking some heat on the market order and the stop entry. So that's this one. Same ratios though, but I'm just making it big blue because this is trying to. Maybe that's not a good idea. Here, let me just make it fatter. That blue is just killing me. So let me just make that black. I'll just make it bolder and make this the skinny one, so maybe these are bigger orders. And so if I could have one that's just half the risk. So if I duplicate entry here, I don't want to duplicate the skinny orders. And these are just be with smaller order bank, less size to each order. And then this is the big fat, like I just know I'm right. And maybe this one, your entry Maybe lay these first. So you see the doji here on the 1 hour, and you put you see the doji. Now you're going to drop this order bank, and you get a perfect fill, and you never get stopped out. But you've also got your, oh, I want to buy on stops. So these skinny guys are the stops, and maybe these are the trend trade orders. And you bracket, so you put in buy stops on this doji. Now you're long for, well, actually, no, that's not right. You'd have to, I wouldn't trade stop entry the same way. So if my stops are here, I'm going to look at it more like a trend trade. I'm going to compress this whole thing down and take very little risk, because I'm going to go with the order flow. I'm going to cut the risk in half on stop entry. So if these are my buy stops, and those are my catch a falling knife orders, because they're thicker, they'll catch it. Take this down to half the risk, and now this will be your trend breakouts. And maybe you stack up 3 breakouts here with a master stop, and see, you didn't make too much money there. So now you have to take this down and risk even less. The stop entry stuff, you've just got to be right out of the gate. If breakouts are real, they should cascade immediately. So I'm going to take my risk down even less. I'm only going to risk 25 pips, because I don't see the point, right? If you're going to get in like this, it's like you're chasing it at the market. I mean, you got to have you got to be buying at the market. You got to be getting it, like, if these are small orders and you know they're going to suck. So if you're buying at the market, you bought down here at the 50. Okay, you did good, right? But it retested deeper. This would also be a buy limit, smaller buy limits. So I would say, for just a visual aid, if you make these your larger time frame, in other words, these orders are going to last all day long, and you can fine tune that. And your skinny orders are like, these are like your scalps, and these are 15-minute orders. But you know that in the big picture, if you place all your monster obvious pivots at the beginning of the day, and of course here's the daily, this is a 50 pip risk, and the other one would be your, you know what, I'm just going to scalp a little bit. So you're living inside of this other thing. When the market's going through this chatter, and maybe you're dropping in this where you're only risking X, right? 25 pips. And so 50 is now on this, here, no, it's like this. I don't have the 25 pip grid up, unfortunately. So you have to put the 25 pip grid up if you really want to calibrate the 100 to the 25 and do all that. So essentially, like, this is your tighter, but you're living inside the handles of the bigger fib, you know. Or you could take this and stretch it right to the start on the 50 with the 0, and then put your max profit at that, so it'll locked in like this. So you could live your whole life with these two strategies, and you could always take this down to the stop entry where it's almost like a hard stop. You get a top, and you have a hard stop on that, so you made money on that trade. The market went rocketing through those candles. The script doesn't last that long though, and these trend trades are garbage sometimes. Like, imagine these are 3 stops stacking up, 3 buy stops, and here's your hard stop at 0. So you're risking whatever that is, maybe 30 pips, whatever. But the idea is that, you know, if every hour you kept placing a buy stop cluster, and you place it again, and it keeps ratcheting up on this thing. Your last buy stop here is the say the 2. You're risking very little here. You're risking like whatever between that is, like maybe that's 15 pips. it goes rocketing through. It probably gets some slippage on that explosion, but you're out of that thing. You're out of that trade almost to the 2-1 up here by the end of that. Boom. Maybe you never got filled on your buy limits, or maybe you did. And so if you're trading with a bias to the upside, you'd be trading the kickback. So here's your small scalp banks. Here's your you're going to hang this opening doji at the 100. At this point, if you change this risk reward ratios, you're screwed. So you really have to think in terms of how deep are you going to place this order. So the opening, if you put your 261.8 at the doji, then you can see, oh, I want to buy at the 100. I want to buy. You never got filled on this bank though, so that was too deep. That never filled because it starts buying at the 50. So if you had it here, where would it have been if you were to maybe this doji, right? But you can't think like that. You got to look at the last doji. See, every hour you have to look at this chart. So here's your doji for your buy script, for your just complete, or at the market, right? You're buying at the market. It clears that thing. Also, you have the, you may have a baby sell limit above that. So if you're constantly riding this thing, you know, this is resistance up here. Your first fill should be at the 50. Your stop is, and this would just be the 100, 50 pip risk inversion of the other one. And you're running this forward. No fills. No fills. You finally get filled here. And you didn't get stopped out. So you took an absolute, this doji is your sell. They come up, they trap it, they pull it back, and you never cashed out on this last order, but you took these scalps with you. But you're always placing the buy stops and the buy limits along here. So even this line here, which is a 50 pip, just trolling at 50 pips sideways, if you just keep dropping this, you're always going to be taking this much risk. So if the 50 is at the 50 and your stop's at 0, you did get stopped out here, but this constant chatter in here, and of course at this point you'd have to be running a tighter version of that. Your 50 needs to be at the bottom of these wicks, and for the most part, if you keep dumping, maybe you don't get filled on this bottom order, so you get filled here. You just keep churning this down. These are greedy. In the end, these are greedy ratios. So you may want to just take this down to just a simple double your money, and run multiples of that same order over time. So instead of committing to some insane locked-in fixed thing, you just keep dropping single orders that come in with a buy limit, a buy limit, a buy limit. As the market's dropping, it's running in front of it by X, and it's contouring to current data as it comes in. But that means you got to keep pressing that button. If you take a more peppered approach, then the linear grid works too. Fibonacci is asking a little. It's a little bit of a greedy plan because you're actually asking for the market to come into such a tight range and bounce out. If you just took I'll buy every 25 pips. And as the market's churning away, it's drifting around and those orders are evaporating. It's constantly trolling for that. You know what? If it goes down 35 pips and it bounces up, it's got a 10 pips stop and it's going to make 20 pips. And you just keep dropping that same order. You're just trolling. Or you got the buy limits down here that keep filling at that doji. But that you got to keep reloading. After each profit's taken here, you got 2 clear dojis at the 50. So, you know, I guess if you're starting off in the beginning of this thing and you don't want to get all complex with Fibonacci, I'd say just go for the painfully obvious trades that they love this 50 and maybe the spread's pretty bad there. But the revisiting of this doji is a constant. They keep dipping into this window here, maybe a 20 pip window. So find the last, and this is all, now it's just manual. The Fibonacci, another problem with Fibonacci is it's fixed. The market's a little more organic than that. So find the real, block off the dojis, see that it's at the 50, and now you got your brain around a simple trade. You're going to buy anywhere within a 20 pip range around the 50. So here's your entry window. And every time it goes up, you know, and maybe you risk 18 pips to make 30 pips. Now you're going to drill down into a super deep kind of, oh, maybe you're trading 10K this whole time and they keep dipping in the well here and you keep being filled. They cash out, you reload. They cash out, you reload. This back and forth nonsense. You could either manually place these orders right at the dojis, retest entry, and here you're going to have just a whole diversity of stops, more than Fibonacci could give you. Here's the doji. You want to risk 50 pips? Just buy it at the market. You know your stops down here maybe. Not a 50, it's a bigger than a 50 pip stop. Your stop's on the 50 yard line there. So obviously if you buy one at the market here because it's a wonderful inverted hammer, you think that's great, and just wait another few hours here and you have buy limits with 50 pip stops on all these entries here, you're scaling in on the stop hunt. Buy limits triggered here with a stop. Buy limits triggered here with a stop. Buy limits, and they all have hard stops of 50. Everything's written for a 50 pip stop to make 100. So you keep filling on this thing, and you're like, oh, I'm kind of getting killed. This one, maybe you have a buy limit here to scalp it, and so you're already up in the trade, right? But you know, every time they take it down, I'll give me some more of that, right? And buy limits just beyond this wick is a great, you know, they have a nice symmetrical. You got your was it like a parallelogram? So you see the parallelogram, and then doji, wow, big buy at the market kind of thing, and you build into this thing, and by the time here you're cashed out of you know, you could cash out of most of it or let it ride to here, or there's this monster wick here, and you only have to wait 1 hour, bam, they slice through. This is just the most volatile pair. So you can't just pick up any currency here. I mean, if you're used to trading the dollar to the yen and you go to this one, you're like, whoa, wait a second. What just happened? Like, why am I getting killed? Well, it's only about, what, 6 times the dynamics of the dollar to the yen. All right, euro to New Zealand, it's outrageous. So you can have trolling 30 pip tag in scalps, just limits peppered out here, and you're just like, yeah, whatever. I don't care. This noise is a gold mine, you know, but you're going to need a broker with a tight stop, because sometimes the spread here in after hours sessions, when it gets pretty wide going into maybe the Asia session, so some of these wicks aren't real. We don't know what the spread is on some of these wicks. They could be enormous. But that's why this thing has such insane dynamics, because, well, the spread gets wide, then you can see the it's going to paint twice as wide. If the spread, if you take half the spread, you're looking at half the spread. If you consider the ask is also expanding on here, you cannot see the ask, how bad it was. You may not got filled on this kickback. If the spread went wide and the ask stayed up here, there is no fill on that. So it's a little deceiving. But of course, when the spread gets wide, there's certainly enough going to stop you out. Because if your stop was here, but you didn't necessarily get filled on that. Well, that's another thing, you know, and that's the thing. If you can fix all these robots to fix a pip and fix that, the ideal pip, even if it's a bad spread of say 5, fix it and play back the robot, it's going to look like a genius. But maybe in this currency pair, forget about it. So it may be dreamland to look in there and think about all the pips you're going to make. But here, obviously, buy stop if you keep going, but they might troll this back, right? Buy limits here, 50 pips deep, hand placed on top of these wicks here. It's no-brainer trade, right? But yeah, they could come crushing back at any moment. Look at this retest. They revisit these doji. So revisiting the doji is a classic. Always a great stupid buy limit, plus the obvious, well, what are they going to do? And I'm sure people are bullish as can be right on this first breakout. You cannot imagine how people are like, oh yeah, man, look at this breakout, new change in trend. But we have to come back and revisit the scene of the crime where we congested so hard to get above this triangle. Boom. But notice the last kickback before the painfully obvious fact that there was a void to be filled on the north side here. It's always going to be like that, and this huge vacuum forming here. But wow, you have to have you're looking at running a 35 pip stop on a 15-minute chart here. This is ridiculous, this pair. Go to a 15-minute chart and you can see it's brutal. Now even here, if you have look for 50 pips on this thing. This 50 pips, you just made this in 50 minutes. You made 100 pips in 15 minutes, right? Hand placing buy stops above this top. Like a lughead. Now you could place buy limits at the retest at the 50-yard line with a 50 pip stop. You never got stopped out. You got a 15-minute hammer. If you're babysitting this pair, say you bought every doji down here in this cluster. This is stupid. A serious 15-minute down, boom, buy at the market dump. You just made 25 pips. That's a riot. Now trading this thing, yeah, you gotta totally adjust to market conditions. Obviously, if you put up the dollar, you just wouldn't believe it, right? If you put up the, it's gonna look like this. If you put up the euro to the dollar. You'd be like, that's not. They're the 5 bip handles. And you're like, oh, huh? So yeah, you're on New Zealand and you see people post this stuff, and I don't know who's able to adjust their brain to 500 pip moves in the blink of an eye. But yeah, this is definitely the pair for that. And yeah, this thing's out. Big doji now on the weekly. Weekly doji, 50 pips. Look at this cascade. Look at this never look back. Look at this inverted hammer. It's a 300 pip hammer on the weekly. So when a hole gets filled, if you're up for a lot of pips, this is the pair. Draw the trend line through the bodies. Forget the wicks, so you get in earlier. Hammer City, inverted spinning, like so. This here is a big deal. It'll be a place to buy in the future someday. Certainly for the scalp. And then right now, we're going up. Everybody's going to New Zealand. Right, it's over. So maybe I'll finally get my wish this year that we go to par on this thing. Oh, not, well, actually, dollar New Zealand. I haven't looked at that, but the New Zealand dollar is going to be where everybody goes, because look at this thing where it's been. And now it's coming out on the monthly. Uh-oh. I see a big hole to fill up here. Look at this hammer on the monthly. That was the crowning achievement of the New Zealand. Look at that. That's the most insane, but wow. If it ever takes out this wick, jeez, that is an incredible amount of pips. If you're up for some, well, look at this hammer down. Look at this. Now here's the ultimate doji entry on the monthly. You buy there, anticipating a filling of this void up until it satisfies to that doji. Whew. 3 months of pure bliss. Look at the inverted hammer just for the scalp there. And now the buyers came in. Doji stall out. Okay, so you expect a lot of stuff here. And then there's plenty of trading to be done between this place and this place now. And maybe this is the big... they trapped these guys. They certainly trapped them both, right? Didn't they? Now they broke out this way. They broke out that way. Wow. But occasionally things line up. This channel finishes here in 2006. And holy Jesus. Look at this fill. That's mind-blowing. Just try to get your brain around this rally here. Look at this fill. This is the most astounding currency pair now. Talk about... What was the news on this day? I'd love to see the headlines. Look at this retracement. And they say markets fall faster than they go up. Not in Forex. These markets can go either way. This is very hard. This is a crawl up. This is rocket up. Pull back to the scene of the crime. This is brutal, this currency pair. But yeah, if it ever takes out that... Of course, a big stall out here. Sellers coming in. Look at this inverted hammer. That's the low risk entry. So any of the dojis and hammers you would bracket on the weeklies, and you're off for a ride that you can't believe on the weekly. It just keeps crushing in to the weekly support levels. So quite crazy here. Inverted hammer here. The obvious stalled out doji entry. And the weekly. Look at the size of the wick on that thing. Here's the low risk entry. Baby bodies. Huge explosion. You're in trading range now. Definitely could totally retest that. 100 pips deep. Here's the obvious support is the body of this. Goes back to this big breakout. But you're always got to be on this 1 hour chart, unless you've got all the more money than God. Because who doesn't want to make 150 pips on a high probability? Comes back to this, or maybe plunges into here, shoots back out. That's tremendous. That's 100 pips up and down here. 100 pips down, almost like 150 pips up. More if you had the stupid redneck sense to buy at the, just put a grid out there and just forget about it, right? It craps out at the 50, it craps out at the 50. All your sell limits got to go up here for the scalp, for the pullback off that top. I think I start picking off these bears here at some point. Go after that, come flying back. So, but you got to be up for some serious pip damage here. And that's the 1 hour chart. For God's sakes, here's your only chance to get on the short train is these dojis. Hit that sell key. At the market on stops, on limits, but or even buy. It wouldn't matter. The idea is that it's paused out. You have a doji that's 40 pip doji on the 1 hour. Here's a 20 pip doji. You don't see that very often. That's a buy key for 50 pips. 60 pip no-brainer trade there. Here, I guess you got to go buy stops and sell stops. You're stuck with the doji trade on the 1 hour. So you can only do what the market gives you. There's no, we could go slamming up. You could hit all your amazing targets, but you should be able to make 20 pips with a 10 pip stop here, no problem. Just buy at the market with a 10 pip stop to make 20 pips. The spread's going to kill you here. You're at 6 pips going into the close, but maybe the spread's going to tighten up when the market opens. Maybe this is the closing spread. And some brokers have a great spread on that. Anyways, that's my Euro New Zealand strategy.